Excellent. Well, look, thanks everyone, and good afternoon, and thanks for attending our seminar today. For those of you who don't know me, my name is Hank de Jong, and I'm the founder and executive director of de Jong Reed. I'd personally like to thank everyone for joining what our second or third webinar so far, and hope that you find today's discussion worthwhile and entertaining. Ashley Shield, our Melbourne-based director, will lead our webinar today and discuss a very important subject. That is, how can we identify the clients who really need help during this hibernation period? Now, for some of you, past events such as the global recession that we experienced in 2007, that left a sour taste as companies and firms that you may have represented did not survive the drive and ultimately ceased operations, and you as professional advisors were out of pocket financially. So how can we be smarter this time around? Well, we're lucky that our government has chosen to introduce this hibernation period. Now, that's great, as this is a major benefit to your clients if this is handled well. The opportunity that we now have is identifying clients that are or will be deeply affected by the COVID-19. Identify them now and start looking at options that are available during this unprecedented calm period. This type of action will assist clients enormously that otherwise might end up being casualties of this current economic situation. There'll be a Q&A session at the end, and we really welcome your participation. So once again, thank you for joining us virtually today. And with that, I'm now going to hand over to Ashley.
Thank you, Hank, and welcome everyone today. I look forward to having a chat as we work through today. As always, before we start, the usual all care, no responsibility is important to note. And we're just going to run through a couple of ideas today. So today, we'll do a quick little chat around what's happening in the hibernation phase, what we're seeing, and a few things around that area. And then developing a COVID-19 business diagnosis and how you can look at your client lists and work out who should be your top priorities. And then just to finish off, we'll do a little case study of a matter that's has already taken up the opportunity to try and get themselves right post-COVID. So I guess in the hibernation phases, for those who came along last time, you know that we spoke about that we believe that the hibernation has actually worked really well, that the insolvency measures have taken a lot of the pressure off, and along with the government support has actually created this period of hibernation, although I think a lot of the governments are trying to avoid the talk of the word hibernation anymore. But the reality is we've got a lot of people sitting who are able to just wait and see what happens. Now, I don't always believe that waiting to see what happens is going to be the best answer, but that's what we're finding a lot of now. We've also found through talking to our networks that a lot of advisors and particularly the accounting industry is suffering a whole bunch of battle fatigue already. They're smashed with having to sort out JobKeeper, Cash Boost, and all the state incentives that are available, and trying to manage all of that. And then they've had the great pleasure of the ATO telling them that they're getting no further extensions for all the normal work that they would have been doing in the last 2 or 3 months. So having that time to look at it has been very difficult for a lot of advisors. So today, normally when we're looking at clients who are in distress, or when people, the triggers that I guess bring people to look for that specialist advice, being creditors chasing money, being the ATO, getting behind with ATO payments, banks and landlords are often the great cause of what brings people to get specialist advice. Now, while this hibernation phase is in, all of those have been put on hold. There's no real triggers that are being pushed for people to go, I need to look at things. A lot of businesses that we've spoken to, probably for the first time in many years of fighting, they can finally take a breath. Now, rather than using that breath to look at how to get themselves set up for the future, they're actually just using it as taking a breath. And to be honest, in some cases, I think it's really important for people's mental health to do that. But if we don't look at how to come out the other side, more businesses will, the mental health will actually go down. So it can be a little bit counterproductive. And I think the other thing is that we need to keep in mind is that once all of these measures go away and the insolvency protection is gone, then all of a sudden we're going to hit some pretty big hurdles that people are going to have to deal with. And when we start looking to the future towards September, and looking right now that we've got governments propping people up through the wage subsidies, these businesses will probably exit at the end of September. There's a lot of people talking about zombie companies at the moment, and they're companies that really only exist to collect in the funds that are available, with very little chance, opportunity, or even desire to continue to work on the back end of this. So some people are just waiting to collect, and then they'll move on. When all of this stops, our belief is, or my belief is very much that we think that we'll see a large increase in unemployment come September, that all of a sudden we'll start seeing some fairly significant pressure on businesses through insolvency when those protections have gone. And it's quite clear that we're seeing a lot of businesses are not planning for this. Now, an interesting stat that I saw the other day from APRA figures are showing that there's up to 750,000 businesses or loans that are being put on hold at the moment, with a total worth of $250 billion. It's all been deferred, waiting for something to happen in the future. Now, that split is 60-40 between home and business loans. So that's a very big reprieve that people are working toward, that people are using at the moment. Now, using that reprieve, if you're getting prepared for what's going to come next, can be a very useful tool. But if you're not planning, then things are certainly not going to end well for most. So we think September is looking very much like a perfect storm approach is starting to flow our way. With all the support coming to the end, insolvency stopping, insolvency provisions, protection provisions stopping, that businesses are going to be running out of money as they need to restock and rebuild themselves. So we're seeing a lot of businesses now that the restrictions are starting to ease, opening up restaurants and bottle shops, or not so much the bottle shops, but restaurants and various other industries. Having to restock is proving to be an issue because they've spent the last couple of months using their cash at bank to fund things along the way. And I think, again, I think I spoke in the last presentation about how Virgin Airlines is a good example of a business that's using this period to restructure themselves. They were a vulnerable business before. And just this week, or late last week, we saw another big group being the PAS group, which is another retail chain. And interestingly, they're again using the corporate ICU as a way of dealing with things. And a quote from the chair of that board was, "Against the backdrop of many retailers closing their doors, we have taken a proactive action to put PAS Group into the best possible position to navigate through the pandemic and subsequent economic challenges." So taking the opportunity now, when we see this perfect storm starting to come, is certainly something that some of the bigger businesses are doing. And we believe that there is a great opportunity for the small and medium-sized businesses to take that on as well. The other part of the perfect storm that particularly concerns this, and this is something, again, you saw in the PAS group, was that a lot of businesses will be affected by the closures of others. So if you look at PAS, they were heavily impacted by Harris Scarfe going down earlier. Now, Harris Scarfe wasn't a COVID-related, they went in before the COVID thing kicked in, but the impact of losing that income from Harris Scarf certainly had a massive impact on that group, which was partly quoted in the marketplace. Now, for some of us who have got the grey hair that I have, there will be, you may remember back to the GFC and what happened there. You know, Hank alluded to it in his opening, is that what we saw back in the GFC days was that there are a lot of businesses that were impacted straight away, and some of those closed instantly, and others didn't have the relief packages that we do now. But there's also a surge of clients that went into insolvency over a period of time afterwards. Now, what we found talking to our advisors was a lot of people end up losing a lot of clients because they just didn't see it coming, because they were dealing with so many things all at once. And I guess part of what we wanted to talk about today is to assist you in looking at trying to identify the early signs or the possibilities of who may be the ones that are affected, protecting that by talking to them early, and then by restructuring possibly or doing whatever needs to happen for these clients, give them an opportunity to survive, which will then ensure that you have clients hanging around for longer. So the GFC was certainly a big example of that, but in my opinion, what we're seeing is going to be a whole lot bigger and a whole lot more dangerous than what we saw back in those days. So within the COVID environment, I think what's one of the things that I found really interesting as we compare it to the GFC is that I spoke about this in our last webinar, that it's a multi-speed economy we're seeing at the moment. Almost a six, there's every industry is doing things at different rates and different sizes. Talking to a valuer and an auctioneer yesterday, and they've never seen greater times at the moment. They're selling anything that they put up for sale is being sold at reasonable or above prices, because we're sitting on an instant cash write-off of $150,000 at the moment. So a lot of people are buying up to get some of the benefit of that, and also some businesses who are cashed up are buying extra stuff for when they need them. As noted on the screen here, we look at the construction industry. It's been doing extremely well up to about now, but when you look at the approvals moving forward, talking to a lot of the construction industry, there are people that really fear for what will come, and that their slowdown still has not started as yet. And we saw today the government announce a package to try and stimulate that sector, because their slowdown is still to come. Other areas like sports and home gyms and bike stores, they've seen absolute peaks in business at the moment. And in the last 2 months, some of them are actually saying that they've had sales greater than they would normally have in a Christmas period. Now, for those type of industries, there is a real fear that people have probably pre-spent some of their discretionary spending to buy bikes that might have been for the kids at the end of the year, but they've bought them now. So they're actually worried that they're going to have a real drop in sales towards the second half or the end of the year. So you see all of these different industries and different parts of our market are in some very different waves, and I'm trying to look at that on an industry by industry basis is very important to helping to understand where you should be focusing your attention to help protect some of these clients. I make note on the screen there, you've got travel and tourism. Well, that one's a particularly ugly industry, and it's one that I am very familiar with. And so in some cases, those guys may be waiting up to 6 to 12 months to before they're actually able to make any money whatsoever. Sorry, I've just lost my screen there. So I think as I mentioned, I think the key is about trying to diagnose your client base, and try and work out who are those that are actually going to be in trouble first, and then trying to get action to try and help those. So today we're going to look at the high risk, medium risk, and low risk within a client itself. So I've spoken about industry, and I think there's an area and importance for everyone to have a look at on an industry base when you're looking at your client base. And then within that industry base, we've got a number of points here that we wanted to look through. Now, I want to be reasonably clear that none of this is rocket science. These are things that you would all think about, and that you would look at in normal course, but sometimes just having it put on a screen and talking about it some more is very helpful, I find. So please don't think that I'm coming up with any brand new grand scheme. This is just not rocket science type stuff. Now, before I get into that list, one thing I did want to just go back to a quote that came out of the Financial Review on Friday. And they were particularly talking, it came from one of the ANZ bank executives. And one of their comments was that sometimes it's better for a small business owner the smartest thing for them is to wind it up now and walk away with some equity. And that's coming from the head of the ANZ retail and business banking, being a gentleman by the name of Mark Hand. So a further quote from him is that urging business owners is not to stick their heads in the sand during this crisis, and warning those that do not want that they won't recover to take action now, while they can still realise some value. I think it's important that we all understand that waiting 6 months and seeing what happens will erode some of the value that may be achieved in doing some work now to protect those businesses. So when you look at the high risk and the ones that you should be looking at as the first port of call, I think, again, no rocket science here. We're talking about people who already had an ATO debt, potentially under a payment plan, or were struggling to meet that payment plan at the start prior to COVID. If that existed, then there's a fair chance they're going to struggle coming out the other side. If you had clients that already had creditors in play, were already had struggling with creditors and had payment plans trying to manage those who already had rental issues. They're another area that, and interestingly, if I just break from the slide slightly, we had a matter just recently in the last about 3 or 4 weeks ago where a client was in trouble, and then we started talking to their landlord, and the conversation that I had with the landlord was very much around that, well, we want to stay in business, but we're not going to be able to survive if we don't get some help. We all know that there's been some code of conduct stuff around that, but the conversation we had was actually more about the longer term rather than the short 6-month term. Landlord was fully aware that he expected that commercial rates were going to drop over time and he would be under further pressure. So rather than jumping or forcing to stay to the contract now, this particular commercial landlord was more than happy to start talking about rewriting the lease to be an estimate of what we thought it would be and to give the business a bigger long-term opportunity to survive. So this environment has opened up the door to have conversations that you would normally never get to have with people like your landlords. Keeping an eye on fintech debt, keeping an eye on people who have got late or are behind in their lodgements. Now, I know in some cases lodgements have had to be brought up to date to get some of the boosts, but those clients who have been a little bit negligent in the past are going to have issues coming out the other side. One of the other ones, the dot point 4 there, we talk about slow paying debtors and overdue accounts. This one isn't actually about the clients so much as it is about yourselves. So if you're an accounting or any type of financial advising firm who have clients that are getting behind in their bills to you, again, it's a pretty clear sign that they're struggling with cash flow. And they're the ones that we should be talking to now, because if we are going to extract value from the business, we'll help ensure that you look after yourselves and that you can actually get paid appropriately for the work that you've done, and to give this business an opportunity to be there long term so that they can continue to pay you. So for me, back in the days when I had my practice, those that were falling behind were a good opportunity, a good clear point for you to say you're the one, some of the ones that I need to talk to first. So that's a good thing to look at. And now that you're also getting towards the end of year stuff and finishing off balance sheets and financials for the tax returns, if you see anyone with a current negative deficit equity position, it's probably worth having a review of them as well. So in my mind, these are the most vulnerable businesses and the ones that need to be looked at first. So there should be a real focus of attention now, looking at what opportunities there are while we're still in hibernation, while there's still a chance to do something to help them be restructured and set up in a way that will allow them to get that done. So needing that special advice, I guess, is what we're talking about. Now, for those who haven't had much to do with us in the past, our firm provides a obligation-free appraisal of a client's position, and we'll provide a full strategic report on what we believe the opportunities and what things can be done to assist that client. So once you've identified those clients, you're more than talk to either myself or Hank or any of our strategists in the team, and we can have a look at what opportunities are available to help that client. Now, some of those conversations won't be easy. Some of those conversations are going to be very much your chance of survival is very low. So it will be about extracting value now as best we can. Some of those will be able to be turned around and will be able to be restructured in whatever form that may take. And now is a very good time to do that. And I know for talking again to a number of clients and their advisors, that people know that they're in trouble, but it's actually getting them to, I guess, to wake up a little bit and to see this as a true opportunity, as a true opportunity to do what they can before it's too late. And again, it's a very unique period of time where I haven't seen in my career where people have really got time to think about and come up with plans. But I think the problem at the moment is we're seeing a lot of paralysis in the thinking because they believe they've got more time. Now, to move on to the medium risk clients, what you might experience is some of these clients have got some issues, that they may have a tax debt which is under control, is being managed to a reasonable level. Their margins might have been tight, but they were doing okay. So it's again a time to work out what their product mix should be, whether they should be looking at if there's any refinancing that they need to do to reset their finance structures. Is there an opportunity to move out of some products that they don't need to move into, or to reprice their products at the right price? There's certainly been a lot of change in the supply chain and what's available in terms of their product lines for people to use and to get involved in. So just having a look at that. So these guys, in our opinion, are your phase 2 people to look at. They're a medium risk. They could go well, or they may just plod along on the other side of this. But with some extra help, there's a fair chance that they can really grow and develop beyond this time. So looking at the asset protection, a bit of balance sheet repair, and looking at the opportunities that are there for them. Getting those things right with these guys are right now is the primary focus of this group. Then your low risk clients are also very, very exciting in my opinion, and that's because one, they were very strong before. They're going to hurt. Everyone's hurting a little bit at some phase in this cycle, as I talked about with the different speeds of the economy. Some are hurting now, some will hurt later. But these strong businesses have a great opportunity to look to buy, to take over market share with businesses that aren't doing well. They've got an opportunity to acquire competitors. So ensuring that they're set for that is really important at the moment. So looking at, we're speaking to a business broker yesterday, And they're saying that their inquiry to sell businesses have never been higher, and the desire to get the top end price is not as strong as it was before. A lot of people are just not wanting to spend 3 years fighting to get through to the other side. So the strong, low risk clients that you have are worth talking to purely because there are going to be massive opportunities for them to grow their businesses. At the same time, though, making sure that they've got the right structure for that growth is critical now. Looking at their asset structures, looking at their balance sheets, looking at what financing options they can put in place now, being ready to buy businesses or to take over bigger market shares. You know, if 3 of their competitors fall over, are they going to have the working capital resources available to be able to take on all that extra work? And you'll note again that the personal asset protection is there. I think every time we look at something, there's certainly a lot more work for most clients that can be done in asset protection areas. So just to give everybody an idea of the type of thing that can be done, this is a client that we have been dealing with over the last two months. They came to us very early. Client was in the home installation business and was referred to us by one of our referring accountants. The director knew that he'd made some management mistakes in the past and in his first time at running a business, and knew that he'd started causing some issues had kicked in. Before COVID, he already had a tax debt of $150,000. He also had some related party loans that had been put into the business to help get it up and running. But of course, these were not secured in any way. Trade creditors were pretty good. Sometimes, well, quite often you'll see that the trade creditors are funded by the ATO's unofficial overdraft, and in this case, the trade creditors were not particularly a problem. He had a bit of motor vehicle and equipment worth about $50,000. Now, then COVID happened, and around March, everything started going pear-shaped, as it does, as we all know about. And it's quite amazing, really. We're only at the 4th of June, but that almost seems like a lifetime ago, but it's only been 8 or 9 weeks ago. So he had about 60,000 worth of trade debtors, but of course they started being hard to collect almost straight away. They're almost used as an excuse for people not to pay their bills on time. And for our client, he was certainly having some issues. That obviously had an immediate impact on his cash flow, but he was pretty excited about staying in the industry and wanted to continue in the industry long term. In this case, it was pretty clear as it panned out over the course of the first month, and once the JobKeeper announcements and the cash boost announcements came through, that our client would have had the ability to limp through. He would have been able to just hold the fort and hold on till September, when everything started kicking in, or August, or whenever it was that business started to improve. He was able to quarantine himself to the point that he could have just limped through to September. But when you looked at it and had a good chat to him about what he was going to do on the other side, he still had the legacy debt issues, particularly with the ATO, that was going to cause some grief for him. So we decided that, and along with the client, we decided that doing a restructure through this period was the best way to do things. So we went through our normal project management practices of getting plant and equipment and motor vehicles valued by an independent valuer. Goodwill was completed by the client's accountant. New related party loans were required into the new trading entity, and we've been able to set up appropriate GSA and loan agreements in place to secure that. The business was then sold across to the new trading entity for full market value, and proceeds banked into the company's bank account as needed. Now, as many of the debt collection as we could was done, although there were certainly many left. There's certainly some debtors left over. What money did come was then distributed according to the priority and security positions in relation to the various creditors that were there, including some payments made to the ATO. And then the old company was paid then the old company was then placed into liquidation. The liquidator is still in the process of trying to collect some of the other debtors. And just an interesting note, although it's not happening in this particular case study, one of the things that you should be aware of, and again, another reason why you should look to do things early, is that although under the insolvency pushback rules, there is a slowdown in creditors winding up of companies and bankrupting of people can't be done. It's still very possible to get a judgment against a creditor that owes you money. And then what we're starting to see is a lot more involvement of the sheriff's area. And they're knocking on doors and trying to collect assets to try and reprieve on judgment debts. So although you can't go all the way, we have seen, as is like always, that's an opportunity that's been there, but we're actually seeing an increase in activity in that area. So where you think you can just sit and wait and no one can do anything, there are still things that can be done. So in this case, the liquidator is pursuing the debtors, and once that's all collected, we anticipate that there'll be a further return to creditors through the liquidator. So the new business is now set up and structured and ready to rock and roll on the new side of the business for whether it be August or September. The business is now in a much stronger position without any legacy issues, ready to take advantage of the growth. Now, those who might have been sitting around and waiting till this is all over to see what happens, which I think is probably one of the most common phrases I've heard of late, he will now have a fairly good opportunity that some of those won't make it, some of his competitors won't make it through the industry, and he'll be in a good position to really capitalise on that. So I think that sort of wraps up really what we wanted to talk to at a high level today. There's obviously a lot of devil in the details with what to look for and what opportunities are, but I hope that does give you some idea of what to do and what options there are. I think the market, I was saying to someone yesterday that I've never seen a more confusing market in my life with unemployment going up, with so many businesses struggling, but there is just this no movement. Some areas are doing extremely well and almost in record sales, and then other industries are sitting quietly waiting to see what happens. It's a very confusing market, but what I think there's no doubt, based on whether you talk to the ARETA, which is the liquidators body, and some of the plans of the governments that are doing, there is without a doubt an expected tsunami of businesses that will lead to insolvency. And for us, we wanted to give some idea of what we think should be looked at in this early phase of the business, while we're still in this phase, to look at opportunities to do things. I think that, I guess my final point before I'll start opening up for questions, is that when you have one of the four major banks making comments like that, please don't wait 6 months. If you're in trouble, let's start doing something now, even if that means you need to exit. I think there's a clear sign in the marketplace that this is coming. And I'm not being Mr. Negative. I actually think that this is an incredible opportunity for businesses. I think it's an incredible opportunity for advisors to really add value at this point to allow businesses to move forward. So that's pretty much all I had to say today. I really appreciate your time. I think if you have any questions, there's you can raise your hand and then we can get you on to ask your question. I think if you open up the participant field, I think it is, you can, most of you probably know how to use Zoom better than I do, but if you raise your hand, if you have any questions, we'll see if we can provide some answers. I'll get Elise to jump off mute in case I'm not seeing what I need to see.
No, that was all correct. So if anyone have any questions, or you can either use the chat as well if you prefer, or alternatively, if you click the participants button from the bottom, you get to see the list of participants, and at the bottom right corner of that list, there's raise hand button. So if you have any questions, you can also raise your hand and I'll then unmute you.
All right, we'll use the chat box. But Elise, I can't see the chat box, so you'll have to monitor that one.
Yep. So it
Right.
seems
Looks like we've provided everything that we need for everyone. No one's.
Well, sorry, actually, there's now one question from Drilling. What would you suggest if rent commitment is the main creditor that business is struggling with?
Depending a little bit, it depends on what sector they're in, but I do believe that now not all landlords are being very receptive to it, but are certainly opening up a conversation about with the landlord, using in the first instance talking about the code of conduct and what should be made available under those rulings. But what I've found is actually talking beyond that about wanting to make sure that they're there for the long term, and certainly talking about negotiating with that landlord. In some cases, we've even looked at. I had a client a couple of weeks ago who had a lease in place that was certainly, I was probably signed up to an exorbitant lease to start with, but there was no personal guarantees there. So in reviewing that the lease, we had an opportunity to go back to the landlord and say, mate, you're going to have nothing if you don't play with this. And this is the state we're in. So we put ourselves in a fairly strong position. So normally starting with what obligations the director might have personally, and then opening up the conversation is very important.
We haven't received any further questions in the chat.
Awesome. Okay. Well, we've obviously done a good job today. Well, if there are no other questions, and if anyone doesn't have anything else they'd like to add, then we'll finish it up and let everyone get on with the day. We thank you very much for your time, and we'll see you again soon.